What's going on, Jello family? In today's video, we're going to talk about how to invest for retirement. So I'm going to tell you what I've been doing. There's basically three things I've been doing, and they've worked pretty well for me. I've already got around six figures in retirement. I'm still in my 20s, which has been great. And I just want to kind of go over what to do and what I've been doing. So that way you're not kind of too demystified and scared about the process, right? A lot of times we start saving for retirement too late, and I don't want you guys to kind of get scared. A little bit about me. I'm a PM at Google, as well as I'm an MBA from UCLA Anderson Business School. So I have a background in finance and business, and everything I learned wasn't actually through work or through school. It was all really being self-taught and just figuring out the answers on my own. Fortunately, we're at a time and age where YouTube is so big and so great when it comes to learning and teaching everything we need to know about finance. So let's kind of dive in on what to do. So first thing I recommend is set up a Roth IRA. I set up a Roth IRA just through Robinhood, but you can set it up through any basic investment firm. And essentially, that money you put in, it grows tax deferred. And then when you're able to basically take it out after that retirement period, I believe when you turn 65 or so, or during retirement, you can get that money tax free. So the max you can invest every year is about $6,500 or $6,500. So what I do is, like, at the beginning of the year, I basically save up $6,500 and I put that all into that Roth IRA account with my Robinhood account. And then what I do is I purchase S&P 500 ETF. So I just get the VTSAX or VTSAX, and then I just basically buy $6,500 worth of that mutual fund. Essentially, the S&P 500 VTSAX, VTSAX is just is an investment fund that just mimics and follows the market. So aka it follows the S&P 500, which are the US's top 500 best performing companies, and it grows around 10 to 12% every year, and it's very steady, it's very safe. Warren Buffett actually recommended that most people shouldn't try and beat the market or try and kind of game the market, because you gotta realize you're going against like lots of hedge funds, investment firms that have tons of research, tons of knowledge, that are all trying to beat the market, and you usually are just the person at your desk buying and choosing stocks that you hope go up, right? So the first thing I do is basically at the beginning of the year, or whenever you have that 6,500, you can put it in every paycheck. You can aim for like $500 a month, and then you should get around $600 a month, and you should be able to get that 6,500 per year, and you just invest it into your S&P 500 VTSAX investment vehicle, which is you can get through like Robinhood or any or Schwab, whatever brokerage you do go through, right? And if you do have 1099 income, which is income you get from like consulting or from not your full-time job. Usually full-time job is like a W-2 income. So 1099 is like you get income from YouTube, whatever it may be. If you have a certain threshold that you hit, you can actually use that $6,500 as a write-off. So if you have a business and you want to write that $6,500 off, ask your accountant, but you can write off partial amount or most all of it. I'm not sure for your Roth IRA account. So that's like the first way for you to start investing. It is basically opening a Roth IRA account. That money comes in post-tax, and they will grow tax-free. And then when you hit retirement age, you'll be able to withdraw that money tax-free, and that is one avenue for you to start investing through for your retirement, right? A Roth IRA account. Next account we're going to talk about is a 401k account. So 401k is basically the retirement account you get from work. For most places, if you're lucky, you get 50% match. I believe at Google, we were able to invest $20,500 a year in retirement, and then they'll match 50% of that, so you get around $10,250 in matching. So you have around almost like $30,000 in retirement investments that you can do a year through your company 401k account, and that money basically goes in pre-tax, so it's not going to be taxed. But when you withdraw that money when you turn your retirement age, you will be taxed on that. However, the good thing about that is that it basically is money from the company, right? So that money you put in at $20,000, they'll give you $10,000 back, and then you get free money from the company, right? Because most employers, once you start working, or if you've been in work for a while, they have an employee matching program, and that employee matching program is essentially a way for them to give back to you for kind of being, I guess, an employee. Most of them, they go through Fidelity or Vanguard, and those are just like one of the large asset managers in the United States. Asset managers means they're just companies that hold your money, and they make it grow for you by investing in different types of investments like stocks, bonds, mutual funds. And basically that's how they kind of grow your money. So very very interesting way of investing, right? It's a way for an employee to give back, right? So I always invest with my employer's 401k plan, and you get this 401k plan whenever you start working. So reach out to your employer. Usually on the onboarding package, you'll get 401k, and they'll tell you how much they match. If you're at a really good company, like say like Alphabet, or like any big tech company, or any big company that's been around for a while, you get around 50% matching, and I think it's every year it changes the amount of you can invest, right? So I think for 2024 it might be different than 2023, 2022, whatever it is. So just keep that in mind, or whenever you're watching this video, every year that amount will be changing. But if you're with a big company or a good company, they'll try and match around 50%, and that's free money for you that grows tax free. And then, however, when you withdraw it during retirement, you will be taxed on it, but you did have kind of growth and financial gains from that investment vehicle. So take a look at that 401k, right? And the third and final way, which I invest, is it may not be available to a lot of people, but for me, coming and working at a big tech company, you're actually paid in equity. So Alphabet or Google, from what you guys know, they pay their employees stock, bonus, as well as equity. For me, I actually get paid in equity every quarter or so. We get equity, and what I do is with that equity is because I am very comfortable and that I know that hoping that Google will be around for a long time. I actually just keep all the equity. I don't sell it at all, and I have it in my Schwab account, right? So if you're fortunate, if you're lucky enough to have companies that give you equity during your job, I recommend you either keeping it, right? If you believe in the company, like if it's an Apple stock or say Google stock, and you think that it's gonna be around for a long, long time, just keep that stock in your investment account, right? Don't sell it, because for me, like I've had Apple and Google stock, right? For me, the Google stock that's come into my investment account, like a Schwab, I'm very comfortable with it growing throughout the years, right? It's beat the market in a sense where it's allowed to just kind of grow, right? I've seen Alphabet beat the S&P 500 over the past few years, so I'm like, all right, well, if there's so much growth in this, then I'm going to keep my money in there, right? Alphabet, you feel comfortable with, especially now with artificial intelligence. They're trying to just basically kind of jump on that train, that bandwagon, being a tech company. So really, for me, all the money I get from Google's stock every couple months or every quarter, I keep that in my investment account, and I don't sell it, right? My opinion is that I'll use it if there's a rainy day and I need it, but let me just keep that for retirement. So fast forward like 40, 50 years from now, from when I retire, I'll have money in the account. I'm like, okay, Apple or Google, it grew a lot, so I'm going to just keep investing that, keep allowing that to grow. And I just kind of listen to Warren Buffett. When Warren Buffett said, when do you ever sell? What's your timeline to sell? He said, I just keep it as long as we can. So for me, I keep that equity as a portion for me retirement. I had a friend, one of my best friends, he went through an IPO, and he just kept all the equity in the account because he wanted, hey, this is probably for retirement. So for me, I keep all my equity given by my employer in that account, so that way it kind of can grow over time, and I'll be okay with regards to how the investment works. For me, keeping a stock that is I feel comfortable in it, right? Especially if I'm doing YouTube, right, which is owned by Google. I'm gonna keep that stock there for as long as I can, allow it to grow, so that way my investment through the company can take form and really just grow as much as it can. So those are the three ways to really start investing, right, for retirement. One I think really recommend is that Roth IRA account. So if you're just kind of don't have a full-time job, but you have income coming in through part-time jobs, whatever it may be, or just work that you're doing, open up a Roth IRA account with any brokerage. You can just sign up, and then you'll get 6,500 is, I believe, what you can invest in. It may change over year, but when you purchase, once you put money in that Roth IRA account, you do need to purchase equity or an investment vehicle, and I recommend VT-SAX, which is an S&P 500 mutual fund or ETF, and it'll grow and mimic the market. What Warren Buffett really recommends, especially if you're not trying to kind of go crazy and try and beat the market because you are just a normal person, right? Another way is 401k. 401k is your employment-sponsored retirement fund. I believe it changes every year, but most employers that are big companies would give 50% match. So max that out, right? You don't need to put your entire paycheck in there all at once, but just kind of try and hit that 20,000 goal at the end of the year, so that way it can grow. And then they'll invest in a Vanguard fund or a retirement vehicle fund that will basically help you invest, and you will draw that money at the end of the year or at the end of your retirement. So that's another way. Last but not least, if you're fortunate enough, or if you can, and you do get paid equity and you believe in the company, just keep as long as you can. Have Google stocks, so I'm just gonna keep that as long as we can, and that will be a retirement vehicle for me. Even though when I do withdraw that money, I will have to capital gains tax most likely. However, just allowing that money to grow rather than just in the savings account and just losing money through inflation. So I'd rather have that money in an equity that does grow and I do have faith in. I hope that helps, Jello family. I really hope that helps. These are like my 3 avenues of how I'm investing for retirement. Please like, comment, and subscribe. I'll make more finance and business videos for you guys going forward. So I'll catch you later, Jello family. Please follow me on Instagram, and I'll see everyone. Have an amazing day, Jello fam. Peace.